The apparent easing of the debt crisis in Europe is not easing our next guest. He says continuing problems over there could spell over onto our shores and lead to another banking meltdown in 2012. David McAlvany is CEO of McAlvany Financial Companies, and he joins us now. David, you talking about a 2008-like crisis?
I think 2008 was a crisis. I don't think it was the crisis. That, I think, is going to unwind, and we'll see it in front of us.
Wait a minute, you're saying it'd be worse than 2008, what we're heading up to?
Absolutely, absolutely. What we had in 2008, we started with pristine balance sheets with our central banks, and we were able to take all of the problems that we had with individual financial institutions and roll that over sort of from these individual corporations onto the public balance sheet, so to say. So we've seen an expansion of our balance sheet to close to $3 trillion. We've seen the same thing with the ECB. And so we have kind of the same problem. They're spent up. We can't really push the sovereign issues up any further.
Well, I understand that there are a lot of things in the financial statements of big banks like Citi and everything that people question now. But back in 2008, they were just loaded with all kinds of bad information about how much these subprimes were worth. Didn't we get rid of a lot of that? Didn't we rationalize the books back then?
Actually, we didn't get rid of any of it. We got to mark things to make believe. We got to mark them to fantasy. We took away the FASB rules. What happened in the fall of 2008 was everything was going to have to be marked to market, and there was a panic. Then FASB rolled that back and said, no, no, no. You can come up with a model. You can come up with some sort of a fantasy of what it should be worth, what you think it's worth, and we can hold it to fair value. That's what they've played with. So we have a lot of toxic assets still on the balance sheets of banks.
What does that mean for my money? I mean, there was a real danger in 2008 that I would go to my bank and I couldn't take my cash out. Are you suggesting that something similar to like that will happen?
Well, I think one of the things that's different than 2008 is we were faced with a real liquidity issue then. We're faced with a real solvency issue now. And the question is, what is the trigger here in the U.S. financial sector and in the U.S. bank sector?
But could our banks actually crash to the point where we couldn't go in and get our money out?
I think we could see up to 10% of U.S. banks, up to 20% if you're including U.S. and European banks, either bankrupt or nationalized.
Now, what about a bailout? We were told that all these new regulations that we have are going to prevent too big to fail, prevent more bailouts. I assume you don't agree with that.
Well, the problem is they're even bigger today than they were in 2008. I mean, if they were too big to fail then, David, how big are they now?
Let's just focus on that because we've talked about it before here. The top 4 banks in the country right now have 62% of all the commercial assets. 4 or 5 years ago, it was much less than that. It was 54%. So despite all the regulations, we're becoming more concentrated.
Yeah.
We're having more too big to fail companies.
I think when people understand the nature of fractional reserve banking, they'll appreciate how frail banking is.
I don't understand. So let's not throw that phase around. Talk turkey to us.
Well, let's say I'm the bank and you give me $1 and that's the deposit. Would it be strange that I lend out $10 instead of the $1? Mm-hmm. It might be. And yet that's essentially what happens through fractional reserve banking. And it means that out of a $10 portfolio of loans with only $1 of assets backing it, it takes very little volatility in that loan portfolio to put me as a lending institution out of business.
See, what kills me is that we have spent the majority of the time over the past 3 years, regulation-wise, trying to prevent all this from happening again. And we have come out with a lot of regulations. We've had on a lot of small bankers who say it's hitting them because they couldn't afford the lobbyists for the cutouts that the big banks get. So we are killing the small banks. The big banks, as we see, are getting even more power than they had before. So all this regulation is not only for nothing, it's making things worse.
Yeah, I think one of the things that's sort of diversionary is the fact that they're coming up with good numbers in terms of earnings here in the third and fourth quarter. As we finish the year 2011, we have the idea that banks are sort of back in business. The problem is they're crafting those earnings using derivatives. That's one issue. The other is they're moving loan loss reserves across and counting them as profits. So, I mean, what we see is very much a prettied up pig. I'm afraid that we're going to see some of that unwound in 2011.
So what we saw in MF Global, John Corzine's group, is going to be happening at other bigger banks like Citi and others.
Everybody's comfortable with leveraging up, leveraging up, leveraging up. You can get away with that in a growth cycle. But when credit contracts or you begin to look around at your neighbors and say, you know, how about that collateral? We still have it, right? Or maybe we need a little bit back. That's when those leveraged portfolios begin to unwind. You're seeing that happen in Europe right now, where banks will not lend to each other. They're going to the ECB. There's so much concern.
Or coming to us through the IMF. We got to leave it at that. David McIlvaney, it's a scary picture. Glad you pointed it out to us, I think. David McIlvaney, CEO of McIlvaney Financial Companies. Thanks again for coming in. Well, the